We call them accidents, black swans, unforeseeable shocks. We're told that crises are unexpected and unavoidable. But if that's true, why do they keep happening? Different decades, different markets, yet the same pattern repeats. The tech bubble, the 2008 financial meltdown, the sovereign debt crisis, each time we act surprised. This video isn't about secret plans or shadowy figures. It's about something far more predictable, the systems we've built. The rules, incentives, and structures that make crises an inevitable part of our economic landscape. We're going to look past the headlines and uncover how crises are not so much planned but designed. First, let's redefine what a crisis really is. It isn't a single event like a bank failure or a market crash, that's just the symptom. A real crisis is a breaking point, the moment when a web of incentives, debt, and sky-high expectations can no longer hold itself together. The shock, whether it's a pandemic or a bad loan, doesn't create the weakness, it just reveals what was already fragile. It's the final domino to fall in a line that was set up years in advance. And every single one of them begins with a boom. Every crisis is born from a period of incredible growth and optimism. Credit is cheap and easy to get. Asset prices, whether it's stocks, real estate, or crypto, are soaring. Everyone seems to be getting rich, and this widespread success creates a powerful illusion, the belief that risk has somehow disappeared. People start thinking, this time is different, but risk never vanishes. It just hides. During the good times, it doesn't get smaller. It accumulates quietly, building up pressure beneath the surface, waiting for the right moment to erupt. The tool that turns a simple boom into a devastating bust is leverage. In simple terms, leverage is using borrowed money to amplify your results. It's what turns a small gain into a massive profit, but it's a double-edged sword. It also turns a small loss into a catastrophic collapse. Our financial systems are built to reward leverage during the good times. Banks, funds, and even regular investors are encouraged to take on more debt to chase higher returns. The problem is, the system rewards the upside but punishes the downside all at once, in a sudden, brutal correction. This brings us to the core of the design, incentives that ignore long-term risk. Think about it. The people making the big, risky decisions, the traders, the CEOs, the fund managers, are often rewarded with huge bonuses based on short-term profits. If their baits pay off, the profits are private and immediate. If they fail, the losses are often delayed, pushed onto the company, the shareholders, or even the public years later. By the time the bill comes due, the original decision-makers are long gone. This isn't necessarily corruption, it's a fundamental design flaw in how we reward performance. So, why don't regulators just fix this? The simple answer is that regulation always chases history. Rules are written in response to the last crisis, not the next one. By the time a new law is passed to prevent a repeat of 2008, the markets have already evolved. Risk has found a new home in a different, unregulated corner of the financial world. Regulation is playing a perpetual game of catch-up with innovation, which is why the same fundamental problems reappear in new forms. And when the system finally does break, who steps in? Central banks, their job is to prevent a total meltdown. They inject liquidity, lower interest rates, and organize bailouts. These actions are crucial for stabilizing the economy and preventing a complete collapse. But they also have an unintended consequence. They preserve the very structure that caused the crisis in the first place. By softening the crash, they ensure that the system doesn't have to fundamentally change. Crises become managed cycles of boom and bust, not true endings that force a redesign. This leads to the most important question: who ultimately pays the price? It's not the system itself. The cost of a crisis is socialized. It's paid by ordinary households through job losses, by small businesses that go under, and by taxpayers who fund the bailouts. The gains from the boom, however, remain concentrated at the very top. The result is that after every single crisis, the gap between the rich and everyone else gets wider. Inequality isn't just a side effect, it's an outcome of the design. So, can crises be prevented? Not entirely. As long as our economic growth depends on ever-increasing debt, and as long as our incentive systems reward short-term risk-taking, crises are a feature, not a bug. They function as a violent reset button that purges bad debt from the system without ever changing the rules of the game. In the end, crises are not designed by a secret cabal of people in a dark room. They are the logical outcome of the incentives hardwired into our global economic systems. So the real question isn't if another crisis will happen. The question is who will be asked to pay for it next time. If you want to keep exploring the hidden mechanics of power, money, and the systems that shape our world, subscribe for more. Thanks for watching.